Hello, this is Eric from MarketSkeptics.com, and today I wanted to talk about foreign reserves. Now, the reason I haven't talked about foreign reserves so far is because the Fed doesn't have any. There's gold here, but as we'll see in later videos, it's not there anymore. And the rest, in this grouping right here, the other Federal Reserve assets, there's around 16 billion, which is nothing. So what are foreign exchange reserves? Well, they are assets held by the central bank in different reserve currencies such as dollar, euro, and yen, and gold. The purpose of foreign exchange reserves is to allow a central bank to purchase its currency, because this action can stabilize the value of whatever that domestic currency is. For example, let's say China and the yuan. When China decides to float the yuan as an international currency, if, as some commenters expect, there's a capital flight out of China, well, China has over $2 trillion in foreign exchange reserve, mainly dollars. And so it can just buy the yuan and offset that and defend the value of its domestic currency. The US, by contrast, if there starts to be a run on the dollar, since it has no foreign exchange reserves, it is completely powerless. The US lack of foreign exchange reserves essentially means that the currency is defenseless. Now here are the biggest holders of foreign reserves as of exchange reserves as of 2008. You have China, of course, and Japan, Russia, the Eurozone as a whole, and Taiwan, India, Brazil, South Korea, Singapore, Hong Kong, and Germany alone out of the EU holds a significant amount of foreign reserves. Now, you will notice that all of these are mainly big exporting countries. The US on this list, well, I think we beat out a few small nations. Now, I want to talk about gold and its job as an official reserve asset. Here are the nations with the biggest reserves of gold. The first is United States, but as we'll see later, this doesn't actually exist. Next is Germany, which experienced hyperinflation 80 years ago, so it's no surprise that they have one of the biggest hoards of gold, with the biggest share of their foreign reserves actually in gold. Now, going down this list, notice all the European nations which are in the top 13. This has to do with gold's historical role as the world's reserve currency, and the fact that all these countries started out with big piles of gold when the gold standard ended. Another fun thing to note is the Republic of China. It has 600 tons of gold, which might seem like a lot, except when you realize that it's 0.9% of their foreign reserves, it's not much at all. So what does all this mean? Well, to show you that, I've put the balance sheet of the US, Japan, and Germany into Excel, and I want to show you what would happen in the case of a dollar collapse. So, as you'll see in all my other videos, that once the run on the dollar starts, the US will start buying tons of treasuries, monetizing that debt. Dollars will come back from overseas. This huge supply, the dollar will lose most of its value as the money supply increases to infinity. Anyway, what does that mean for Japan, which, with its close to $1 trillion in reserve? Well, that's gone. Now, if you remember, when a central bank experiences a a loss. The government, since it's backing the currency, has to step in and issue new debt and fill that loss. So the collapse of the dollar will increase Japan's national debt by $1 trillion, and Japan already has one of the highest national debt out of any developed nation. It has to do with the big real estate and stock bubble they experienced in the 1990s, which never deflated. You see, normally when you have a incredibly large real estate and credit bubble, you either get deflation or hyperinflation. Japan, because the rest of the world was doing okay and because it had so much dollar reserves, got away with doing neither and just delaying the inevitable till a later date. Well, looks like that time has arrived. Japan is running trade deficits, and with the dollar's collapse and the new debt it will have to issue for that and save its financial system, its debt to GDP is going over 200%, which means that the yen is following the dollar into oblivion. Anyway, next is Germany. Now, it's sort of predictable that the nation that experienced hyperinflation 80 years ago is the nation that's been most cautious and is most anxious to avoid repeating that process. Gold is the ultimate crisis hedge. So when the dollar collapses, the value of gold is going to be increasing, and which it means that the euro is essentially backed by gold. The gold standard, for those of you who don't know, involved having 40% of a central bank's balance sheet backed by gold. The redeemability was a secondary issue. The important part of the gold standard was that 40% of the currency was backed by gold. And the increasing value of gold will mean that the EU will soon be in that position. By the way, you've probably read on my blog or somewhere online that Europe's financial problems are worse than the US, and its financial system more leverage, and that reason the euro is a worse investment than the dollar. I'd have to remind everyone that during the Great Depression, 2 out of 5 banks failed, and the dollar went up in value. Having an insolvent financial system is not necessarily bad for the currency. It depends on the actions of the central bank. And in Europe, there is Germany, when it formed the EU, was influential in putting in a no bailout provision in the treaty that forms the Eurozone. And so they need unanimous consent of all EU members to overrule this, and that is not going to happen. You just think of it this way: if the responsible people in the US could have had a veto on the bailout package, it never would have passed. Well, Germany, the responsible nation in Europe, has a veto on bailouts of the irresponsible EU nations. And my guess is they're not going to allow the euro's value to be destroyed to bail out nations like Spain, Greece, and Italy that lived beyond their means for 2 decades. So, for all you people that are worried about deflation, well, it's going to happen, but it's going to happen in Europe.